Hello, today I'm going to show you how to build an all-weather ETF portfolio. These are portfolios that are designed to last through any economic conditions. So you can throw them at inflationary period, bull markets, bear markets, pandemics. They will last and survive with ease. If that sounds interesting, please watch the whole video so you can understand what they are and how to build one. If you're new to the channel, welcome to Investing with Shakib. I am Shakib. I cover personal finance topics. So if that's your cup of tea, please subscribe. All right, let's get started. So what is an all-weather portfolio? It's a portfolio that can survive through all types of economic conditions. And you might wonder well, how is that possible? What's in them, right? So we just talked about economic conditions. So what are some of the economic conditions, for example? So we have expansionary periods, where the stock market and everything's just going up and up. We have contracting periods, where maybe the yields are high, everyone's putting money in their savings accounts and, places where they can earn a lot of interest. There are, recessions. There are very outstanding times like global pandemics where nothing is moving and everything's just falling, maybe sudden crash. Then you have inflationary period where your money is worth less. So all these things. So the components of an all-weather portfolio, they have a specific goal, and each component will handle in one of these conditions that we talked about. So there's total 5 components in an all-weather portfolio, at least the one that I'm talking about. We can boil it down to 4, but 5 is a better way to go. Pros and cons very quickly. So obviously it's really ideal for passive investing. Technically, you could just build it, put some money in it and forget about it. I've done that and it's done very well over the last 5 years. It's very stable growth, reduced volatility when the market is going like this. It'll kind of more like a lot more stable. And then also if market crashes, you don't have to check, but if you did check, you would see that, let's say the whole market went down $10, this will probably go down like $4. So a lot of downside protection, and you don't have to buy any puts or anything like that. This is just all autopilot. Cons. So I think the cons that stand out the most to me is that there's no hyper growth, and you could see that coming because you cannot have really hyper growth. What is hyper growth anyway? Like Nvidia, right? That is a hyper growth stock. Or I wouldn't even, let's say there's a normal stock like Costco. It is growing. It's a very successful stock, but it's still not hyper growth. Hyper growth means when you have crazy runs and you're just going 200% in a year. You're just not going to have that from a portfolio like this. But remember, those type of hyper growth portfolios or stocks, they grow a lot, they climb up a lot very fast. But when they get corrected or they drop a lot too. So that's one of the cons with this portfolio. It's so balanced that it's never going to experience 200% growth or something like that, like a hyper growth stock. And then also in really strong bull market, it will see growth, but it's just not going to see growth like very aggressive ETF that are leveraged or something like QQQ. All right, so let's talk about the ingredients. So 50% of this portfolio will be focused on stocks, equities. Why? Because that will provide you the growth in expansionary periods, right? And then stocks is 50%, so that's a very core item. Gold is 20%, really important. In fact, gold is the anchor for this portfolio. It's going to make sure this thing is bulletproof. And it's just going to keep you planted during all types of uncertainties. And then comes 3 flexible areas, ingredients. Long-term bonds, so it kind of handles recessions and deflationary periods. Short-term bond is more like same goal but shorter term. And commodities, I believe this is something a lot of people think about, but they don't follow through because it needs research. It's not as straightforward to invest in commodities, but you can achieve that goal with ETFs, and I will tell you one of those ETFs. But commodities kind of hedge when you're during inflation, and also with rising costs and everything. It's good to have some exposure to commodities. Okay, so I showed you the ingredients. Now I am showing you the ETFs that will go toward each ingredient. So for stocks, I have a few choices for each of these. You don't necessarily have to buy all of them. You could just pick one. For me, for stocks, I picked 3 and split that 50% of the stock allocation into 3 ETFs. For long-term bonds, I picked 1. For short-term bonds, I picked 1. For commodities, you can just buy the ETF USCI. That should do the trick. If you are sophisticated enough to buy a particular type of commodity, feel free to do so. For gold, any of them will suffice. Okay, so let me show you a portfolio that I built about 5-6 years ago, and it's been coasting really well. It provided me annualized return of somewhere around 9%. S&P at the same time would have given something like 13%, but S&P would have given me a lot of headache, where this thing was just, I forgot that it existed, and it just did so well. And when there were really tough times like COVID times, the correction period around 2022 and 3, I checked this portfolio and it was just coasting, like no problem. Everything else is dropping and this thing's just barely dropping. And if it's dropping, it's like really gradual and like nice compared to other things where it just plummets. And I'll show you how a chart like that would look like. So for stocks, I picked 3 ETFs: VTI, VOG, and QQQ. I wanted total stock market. I wanted a lot of growth, and I also wanted a lot of focus in the tech stocks. So that's why I picked those and split them up into for the 50%. Long-term bonds, TLT. Short-term bonds, IEF. Commodities, 10% on the USCI. There's one mistake that I made in 5-6 years, which is I closed my commodities position. That was a big mistake. I wish I didn't do that. If I didn't close my position, it probably would have provided annualized return of 10% or more, but I got rid of it. I just wanted to simplify it. But yeah, that was my reasoning. And for gold, I kept buying IU, and it did great. Okay, so here's the portfolio. This would be the allocation. Looking at this, it provided somewhere around 9.7, depending on when the time period starts. In here, it's starting at 2015. So when we go down, you can see the return or the growth for the portfolio. So S&P is higher, but it is significantly more volatile. And let's look at the drawdown. That's where this thing shines a lot. So when we go to the drawdown, 1 second, here it is. So you can see how whenever things go south, things go really bad, S&P plummets significantly more, where this thing barely touches. Like for example, right here, around 2020, S&P dropped like 20%, where this thing didn't even drop 10%, not even halfway like S&P. So same thing in other times. So it's really, a peace of mind type of thing, where you want to invest, but you don't want to invest in something risky. It's kind of like parking your money in a checking account, but it is going to grow and provide you an annualized return of like 9 to 10%. So that's essentially the beauty of it, and it's very passive. You don't have to think about it. But yeah, overall, it's done well for me. I invested in these, I think overall about $10,000 or something. It grew to be something like, I think as of now, I don't remember, but I know that it's something like $14,000 or something like that over time. So yeah, I love it, and this is my all-weather portfolio. If you have any questions, let me know. I'm happy to share this. I will actually provide this slide deck in the video description. If you like the video, please give it a thumbs up. And yeah, as always, thanks for watching.